Good morning, Kinaway members, and welcome to another episode of Kinaway TV. Hope everyone is keeping well on this Wednesday morning. I'd like to start today's webinar by acknowledging the traditional owners of the land on which we are all meeting and pay respects to elders past, present and emerging. For this morning's webinar, we have Tori from TJS Accounting back making her third and final presentation, and we're excited to announce she'll be joined by a special guest. In case you missed Tori's previous two presentations, they're available on both the Kinaway Facebook and YouTube channels. Tori's first presentation touched on the financial principles that relate to your business, whether it be applying good practice when lodging business activity statements to understanding what tax concessions may be available for your business. While Tori's second presentation was based around financial statements, particularly balance sheets, and provided participants with a basic understanding of its various elements. For today's webinar, we're excited to announce Tori will be joined by Warren Russel. Warren specialises in superannuation strategies, retirement income streams, Centrelink optimisation, and tax-effective investing, and joins Tori today to cover the principles that will help create wealth for your family and for future generations. Before I welcome Tori and Warren, I would just like to also remind participants of the Kinaway Business Tax Support Packages available. These specialist support packages help provide access to a range of bookkeeping and accounting services, preparation and submission of tax returns and BAS statements, online access to Xero and MyOb, tax and payroll obligations, superannuation and work cover obligations to staff at a maximum of $1,500 exclusive of GST per business. There is a criteria for eligibility and priority on a first come, first served basis. If you feel this may be of use to your business, please fill out an expression of interest available on the Kinaway website. We hope you enjoy today's webinar. If you have any questions, please feel free to either post them on Facebook or YouTube, as both Tori and Warren will be addressing them after the presentation. I'd like to welcome Tori and Warren, and as always, make sure to leave a like, comment, subscribe, and turn on the notifications to receive Kinaway updates.
Thank you very much for having me back again. Today, yes, we're looking at financial literacy. Just a little bit about me, just very briefly again, I am a public accountant, tax agent, member of the Institute of Public Accountants, where I'm also the Deputy President of the Divisional Advisory Committee of the IPA Victoria. I'm an associate of the Tax Institute, registered ASIC agent. I'm a business owner too, and very proudly the winner of the 2019 IPA Practice of the Year. There you have it, that's my family, and I guess my real why. I thought I'd start today with a really great quote, one that I really like, especially when we're talking about financial literacy. If you don't like the road you're walking, start paving another one, which is a great quote for today's session, which is all about taking control of your money. So I guess getting on the road to financial success is absolutely within your reach. So if you're like many people today who are probably feeling a little bit stuck or perhaps overwhelmed with your finances, or feeling that you can't quite get ahead fast enough, there's a lot to, I guess, understand and know about saving more money or understanding where your money is going. Don't feel bad. You're not alone. Not everybody has a budget, and some of us have bad money habits, but obviously recognising them and doing something about that can really change your life. So how do we get in control of your money? How do you make it a priority? Well, by empowering yourself by really looking at how you can earn, what you're earning, what you're saving, what you're spending, and really how much money you're effectively giving away. So there's 5 easy steps to getting in control of your finances. I'd say to you, get informed. The more that you know about your money, the better the decisions that you will make. Stop living day to day and set some goals. If you want to achieve more, setting goals is the way to do it. Step 3, get organised. Step 4, ask for help. Seek expert advice. And if you don't understand something or you have doubts or maybe you're a little bit unclear about what your money is going, where it's going, or money matters or your investments, don't hesitate to speak to a financial professional. Feel free to make an appointment, prepare a list of questions, because being informed will ultimately help you to make better decisions. But number 5 is, for me, create a budget. Taking control of your money is all about you. So understanding why you need a budget is really important. Understanding why it is that you need to see where the money is going and how do you take control. So a few things about a personal budget. It's about knowing how much money you have. So obviously it's important that you know just how much money you have or in the bank or perhaps don't have, as well as interest rates, banking fees each month, because knowing this kind of information will help you to make decisions on perhaps which bank to be with or which bank not to be with. Figuring out how much money you actually earn. So obviously that's a lot easier for people who are employed, who receive a weekly or monthly wage or salary, because they can easily determine how much money that they're earning. But for many business owners, your income can actually be quite unpredictable. It can be really quite difficult to determine and work out how much money you earn and how much you're actually receiving and how much of that is your money. So if your business is seasonal or it performs better in some months than others of the year, it's really important to understand when this is and why. Knowing how much money that you owe. Working out how much your repayments are each month is really important. It sounds like it should just be simple, but actually if you've got credit cards or if you have an overdraft facility, it can change. So building a budget will actually be the first step towards your financial freedom. Make sure that you include all of your ongoing and your recurring debts, including car loans, mortgages, credit card debt, student loans, and all other debts that you pay personally. Because the next step is to determine your monthly outgoings. And it might seem a little bit scary looking at this, but go through your bank accounts. So I actually recommend using actual amounts that you spend each month and trying not to average out your expenses when you're doing a budget. So for example, your car registration, it only comes in once a year, whereas we don't split it up into a monthly and we don't pay the registration monthly. Look at your bottom line. After entering all of your information, you'll discover the most important number in the budgeting process, your bottom line. So this number will tell you whether you're overspending or underspending. Ideally, you'll find you're living within your means and maybe even have a little bit left over every month. But on the flip side, it can also make you see, or you might find that you need to make adjustments so that your monthly expenses are not living with, beyond your own means. And of course, make adjustments and stick to them. So if the bottom line of your budget shows that you're overspending, you come to the most challenging step, which is making decisions and having to make cuts in some of those monthly expenses. What I've done here is try to give you a bit of an overview of how we would work a personal budget. And it's a case of going, what I recommend to people is actually getting out their bank statements or using an app potentially or an Excel spreadsheet in this instance. Having a look at how much money we have in the bank balance. So obviously in July at the top there you can see, and this is all estimated, this is not a true, but just to give some guidance. But work out how much you're receiving. If you're employed, you'll see the employment income. If you're receiving family tax benefits or perhaps business income, that can vary from month to month. So too, your expenses vary on a month-to-month basis. So how much money you have at the beginning of each month might differ depending on how those expenses are. And my advice here is to make a monthly budget for a full 12 months and do it on the basis of month to month, because then you'll get a really good understanding of how things will be different. And of course, we have holidays, or we might have birthdays or Christmas and expenditure where we spend more money in those particular months than we do in others. So taking all of that into account is really important. There's lots of ways that you can do budgets. You could download an app like Money Brilliant, Pocketbook, My Prosperity, or using a program like Maya or Zero will also help you to do this also. But best basis is always to go back to those bank statements of yours and go through them. Here's something I really like. You must gain control over your money, or the lack of it will gain control over you. And that's something that I guess none of us really want to be in the position of. And how do we best do that? Well, let me introduce to you Warren Russel, who's from TJS Financial Planning. Warren is our financial planner, and he will be introducing some of the key concepts today for financial literacy and financial planning.
Yeah, thanks, Tori. I hope everyone can hear me okay. Good morning, everybody. Welcome and thank you for dialing into our presentation this morning. I hope you find it interesting. I hope you can hear me. My name is Warren Russel. I'm a financial planner for TJS Financial Planning. I've been planning for nearly 23 years now. Started way back in 1997. So I've seen lots of changes in the industry. I've seen lots of bear markets and bull markets in the stock exchange, the share market. So I've certainly got a lot of experience under my belt. I live on the Mornington Peninsula with my wife and two daughters. They're 13 and 16. There they are. They're in New Zealand last year. They're going through homeschooling at the moment, so they've certainly got their own challenges. So we're lucky to get that holiday into New Zealand last year before COVID hit. So I certainly hope one day all this COVID thing's over and we get back to normal life. Our disclaimer, a bit of speed reading for you, of course. It goes without saying all the information we provide today is purely just information. So in other words, it's not advice. Don't race off and start doing things until you actually get advice from someone. And that's probably the key point I want to raise today is, get advice. I've been around long enough to see people miss opportunities. I've seen people try and start things on their own, and it's been really costly and it's heartbreaking to see. So if you take away one thing from today's presentation, make sure you actually get advice from a good financial planner. I think one of the biggest obstacles that people face, or the biggest challenges, is not really understanding what financial planning is all about. And I know that for a fact. Often people ask me questions about what do you really do in your job. So I think that breaking down and defining exactly what financial planning means, and then people might understand what the true benefits are for them. So what I've done here is I've given you a list of all the main sort of areas. Financial planning is quite a broad area, as is taxation. So I've given you a list there of all the sort of key things that I would look at for clients, depending on their stage of life and their age. So if we just go through some of the key ones there. Savings plans, we'll talk in a minute about the importance of putting money into super sooner rather than later. The second point, superannuation. There's not too many plans we do that don't involve some form of advice around superannuation. Tax planning is really big, and that's why it's fantastic to work alongside people like Tori and TJS Accounting. We can often talk about clients' individual tax needs and collectively come up with a solution for them. Insurances, protecting income, again, it's something that a lot of people don't understand much about. We'll go through some separate slides about the importance of income protection a bit later on. Centrelink planning and retirement planning, this is probably the area that I really enjoy the most. When people get to sort of the tail end of their working life, and we can sit down with them and actually do some proper retirement planning. And the last point there, estate planning, again, it's a lot's not known about what taxes people pay on certain assets when they pass away. It's not a fun sort of topic, but it's very important. So those are the sort of areas that we specialise in with financial planning. The next slide, I'd like to just introduce you to what the advice process is. I think this is important to understand. So basically what we do is we start off with an initial meeting. That's a fact-finding meeting, which one get to know each other. I try to get to know you, you try to get to know me. But basically we'll sit down and we'll talk about your goals. one of the questions I ask people always in the first meeting is what's the most important thing that you want to take away from this meeting? We identify your goals, talk to you about what's important to you, and then we might gather some balance sheet information like your income, your super, and so forth. Once I've got a good handle on what we might be looking at from that meeting, if the situation is quite clear, we can do what's called define the scope of the engagement. In other words, we can say to you, we can do this, this, and this, and this is what will cost you. This is what our fees look like. If we can't define the scope at that initial meeting, we might go away and do some number crunching, and then we can come back and have a second meeting where we can sit down and go through what we'd like to do for you. So an important point to raise here is we're not giving advice at the very first meeting. We're not allowed to. Advice has to be in writing. So again, we're just trying to work out what we'd like to do for you. And then once we agree on the scope of the advice, and you're happy with our statement of advice fee, then the fun begins. Then I can go away and start engaging our power planner to do all the projections for you, all the calculations. And then at that next meeting, whether it's the second or the third meeting, that's where we come back with the written statement of advice for you. A statement of advice is just a fancy name for a financial plan. We don't just mail the plan out to you or email it to you. We actually want to present that to you in person. Now, I guess with COVID-19, things have changed a little. So we're doing all of our meetings via Zoom or via telephone. And that's working reasonably well. It's working a lot better than I thought, actually. So you still get a hard copy of that statement of advice to go through over the phone with. And that's the ideal time to then sit down and discuss the plan in detail, answer any questions or concerns, and then if you're happy with everything, then go ahead and implement the recommendations. So that's the process we go through with everybody. I stress the first meeting, the first and second meetings don't cost you anything. We're really just trying to establish what we can do for you. 9 times out of 10, I can honestly help somebody with something. And the important last thing to state there is that your plan at the moment is good for your goals and objectives now. So over time, as those goals change, we need to review your plan. And that might be in 12 months' time, or it might be in 5 years' time. We don't think your plan is set and forget for the rest of your life. We want to see you back to make any adjustments as things change. I hope that makes sense. Last year, we received some really nice testimonials from our clients. This particular testimonial was something that radiated with me. And I'd like to just take a few minutes there just to read this testimonial for me. Why I like this, I'll just get you to go back there one more, sorry, Tori. Why I like this particular testimonial was, and I appreciate you don't know the client, but this client really had really no idea about her financial position. She felt insecure. She read the words there that she thought she'd have to work till she died. She passes away. And she was really gutsy for her to come out of her comfort zone and come and get advice from me. She's over 65, so and she's on her own, so she's got no one to really act as a sounding board. So where we took this client from and to in terms of not just her financial gain, but her emotional gain and the confidence that she displayed was really important to me, and that's why I thought I'd share that testimonial with you today. It's basically why I love my job. The future depends on what we do in the present. That's exactly what I'm saying through all of these slides. If we just sit back and let things ride along, we could be lucky, we could turn out okay, but I really think that no one's going to change anything to do with your super and your retirement planning other than you. You steer the ship and you do everything within your power to make that a better position in the future. Let's talk about superannuation, because super is a huge part of what I look at and what I do as a financial planner. Do we really have enough super to retire comfortably? Well, I think we all know the answer to that. The answer is no, unfortunately. And I'm just going to excuse me while I read out some figures now. There's an industry body called AFSA, ASFA, that's the Association of Super Funds Australia. they've released some information that says that for a superannuation balance for someone to comfortably retire today, this is for a single person, it's about $545,000 at retirement. Or if you're a couple, $640,000. And I concur with those figures. I think they're probably true. They also then released the actual balances, the median super balances for retiring Australians between the ages of 60 and 64. Now, for men, this is the actual balance, it's $154,000. Remembering that singles need about $545,000 to retire comfortably. Now, for women, it's about $122,000 because their balances on average are a bit less because they've taken time off work to start families. So as you can see from those figures, we are a long way off the mark. So it's up to us to actually do something as soon as we possibly can to improve that position. We're not contributing enough to super. As you know, your employer pays in 9.5% of your wage, normally if you're an employee. And the bottom line is that's not enough. You have to start making contributions if you want to live a comfortable lifestyle in retirement and not have to rely too much upon the age pension in retire. If you're self-employed and you're not paying 9.5, then you've even got a greater challenge. As I said before, women are facing their own special challenges because, again, they've taken time off work to start families and then maybe work part-time if they go back into work. So that's a real issue that the industry has to identify. Right? And don't let the system get you down. This is one of my favourites, and I truly believe in it. People often hang their hats or make their excuse on the fact that all of the rules change with superannuation, so it's just not worth investing in super, and I'd rather not worry about it now. If you drill down on a lot of those rules, and Tori knows this, a lot of the rules are there to actually provide a gain for people. I can go through all the rules that have changed in recent years, and they're actually, you've got to remember, the government is trying to make superannuation attractive for people to invest. They're giving you tax advantages. So don't ever hang your hat on the fact that rules change and it's not working. A lot of misconceptions out there about super and financial advice. Again, we'll go through this together now. You don't need to worry about saving for retirement until you're older. If you understand the power of compounding returns over time, you're far better off if you're going to start contributing to super. The earlier you can do that, the better. I've seen examples where people come in and they might start topping up the super when their mortgage is paid off when they're 55. That's better than doing nothing. I agree with that. If they'd come in maybe 10, 15, 20 years earlier, started putting a very small amount into super, the difference between those two scenarios is staggering. So in other words, don't leave it to the last minute. Super is a set and forget scheme. Well, it definitely is not. If you set up a super fund many years ago, I review a lot of superannuation funds, and the funds that are really old are quite expensive. We talk about the fees on the funds. Don't think because you set the fund up years ago that you can just not worry about it. There's fees to look at. There's your risk profile, which, other words, that's how much it has in sort of shares and growth assets. Always have a look at it. You don't have to review the fund every year, but if you haven't touched it for a long time, come and get some help on that. All super funds are the same. They're definitely not. As I said before, I've seen some very old funds that have fees upward of, say, 2.5%, even 3%. They're the sort of funds that are eating away at people's retirement savings. I mean, getting people to put money into super is hard enough, but if it's all being chewed up with these very high fees from old funds, it's a very sad situation. So not all funds are the same. And I'm not rich enough to see a financial planner. Again, another one of my favourites. Don't think you've got to have $1 million to go and see a financial planner. When you think about it, it's actually the people who have less amounts of money who need the most help. That person I showed the testimonial for before. I can't give you information, of course, but she really didn't have a whole lot of money in her superannuation fund, but she still gained from the advice that we gave her, and look how happy she is now. Just a quick sort of rundown on the sorts of things that we give advice on when we're sort of putting someone's super up on the hoist and trying to give it a bit of a service. The sorts of things we look for are nominating the appropriate beneficiary on a super fund. A lot of people aren't aware that superannuation doesn't form part of your estate when you pass away. It doesn't go through your will. So if you've got a super fund, and you might even have some death cover in that super fund, so it's worth quite a lot. If you haven't got the right beneficiary nominated there, it can cost a lot of money if it goes to the wrong people in terms of taxation. Consolidate your super accounts. Again, you've all heard the ads on radio. Go and consolidate your funds, reduce your fees. Goes without saying. If you've got multiple funds, obviously you're paying multiple fees. But it's not as easy as just going and doing that. You might have insurance cover in some of those funds. So it's not just a case of putting, I've seen this before, where people just pick one fund and roll everything into that one fund. And all of a sudden they're without income protection or death cover because they've chosen the wrong fund. So very important to get some advice on that. This I've touched on already. Make regular personal contributions to your super. Now I know we've got to pay off mortgages. We've got to live. We've got to feed our family and pay all the bills these days. But it doesn't matter how small the contribution is that you can afford to put into your super on a regular basis. Something is better than nothing. And for all those young people out there, as I say, the sooner you can start doing that, the better. There's different contribution rules. You can make after-tax lump sum contributions, which is really handy. Again, when we give you advice, we'll steer you through all of that so you know exactly which way to go. There's a thing called government co-contribution. It's been around for a long time. And again, this is an example of the government making or offering concessions to people when topping money up into the super. They're actually going to match that money. This system's interesting. This system started many years ago. I forget when it was now, but the idea was I think you put $1,000 in and the government would match it with $1,000. I think the second or third year they actually doubled it. So if you put 1,000 in, I think they gave you 3,000 or something like that. So at the time, it probably didn't seem like much of a gain, but it's been in vogue for a long time now. I worked it out one day. If you'd actually put in the maximum amount each year since it started, I think you'd gain something like about $45,000. So that's just the contribution. That's not the earnings in that 45. So don't discount little things like that. And the bottom point: seek professional advice. I can't stress this enough. All these sorts of things we can do for people, but we have to get you in. Probably one of my favourite strategies for people: transition to retirement, TTR. 75% of the clients that we have at TJS Financial Planning are doing a transition to retirement strategy. Now, just to quickly explain how this works. Now, TTR is not for everyone. As you can see there, it's for people around the age of 60 and above. So, in other words, when you reach what's called your preservation age, and you're still working. So, you've reached 60, you're still working, you've got a bit of money in super. You don't have to have a lot. Basically, what TTR does, it allows you to access your super while you're still working, and you can draw down tax-free income from it. Now, you might be thinking, well, I'm still working. Why do I have to draw down a tax-free income from my super? How's that going to benefit me? The idea is you take that drawdown from your super and you then recontribute that back into super in a tax-effective manner, either using salary sacrifice or deductible contributions to reduce your tax. So it works really well. It doesn't erode the value of your super. People often think you start drawing down, you're therefore going to have less super to retire on. It does the complete opposite. It actually pumps more money back into your super. So that's basically how transition retirement works. The other way people can use it is to actually drop back, and this is why the rules were introduced many years ago, where people who wanted to give up full-time work and go part-time, they weren't allowed to access their super. So financially, they couldn't afford to drop back on their hours. So the government introduced these rules. Now, that middle point there, people who want to drop back the hours and then use the income from their super to live off to supplement their dropping their wages, that's a really good way to use TTR. Most people use it the other way, though, where they're recontributing the money to save them tax. And the third option there is to actually use the money to pay off their debts quickly, like their home loan. We don't often see people wanting to do that, but for people who have a large home loan balance, it's a really good way to start chewing away at their home loan. Tax rules around TTRs are very complex, though, so you should seek advice on all of the options. It's a really good strategy. You're braver than you believe. stronger than you seem and smarter than you think. I think that goes without saying. We're going to change direction a little bit here because I want to talk about, I mentioned earlier on the importance of income protection and protecting yourself. Now, this is something that a lot of people sort of ignore and don't really understand their options and what they have in place until something happens to them. I've seen that happen a few times. You've all heard us say that people insure their house, their contents, their motor vehicle, which are important, but they don't give consideration to ensuring their greatest asset, and that is you. Your greatest stability, your ability to earn an income for the rest of your life is your greatest asset. So I want to just basically talk about the 4 types of life insurance first of all. The first one there is just simply called life insurance or death cover. What death cover is, it provides a lump sum to your estate if you pass away through, say, an accident or an illness. It's quite simple, and it's usually designed to cover things like funeral costs, repay the mortgage, provide an income stream for your dependents. So, in other words, if you're the prime income earner and you're only 40 years of age, well, theoretically, that family doesn't have an income for the next 20 to 25 years. So death cover is really important. And of the 4 types of insurance cover, it's probably the cheapest, to be honest. So that's death cover. The second one there is TPD, total and permanent disability. Now, TPD is if you're unable to work, you've had an accident, a really serious accident or an illness. It's not just breaking your leg and you're off work for 6 weeks. If you've had a TPD, it means you can't work again, so it's pretty serious stuff. Now, similarly, this is a bit different though. So if you think of going back to death cover, pass away, you're gone. But with the TPD, what increases is all your medical bills. And that can vary, of course, but you've got medical bills, you've got a lot of long-term rehabilitation. So you've got that extra expense, but at the same time, you can't work. So it hits you both ways. So TPD is really important. And you'll usually find people who have super funds will have some TPD in there. That's really important. The third one is called trauma cover or critical illness. Trauma cover provides a lump sum if you're diagnosed. I describe it as all the nasty things that can happen to your body, like heart attack, stroke, all those sorts of medical things. TPD will give you a payout if you meet the condition of one of those trauma events. Now, with a trauma event, you might be okay. You might get through some rehabilitation. You might be okay and be able to go back to work. So a TPD is normally just there to cover your medical costs in your rehab. And the last one is really important: income protection. Those first 3 are lump sums. The fourth one, income protection, is a regular income stream, and it's designed to replace 75% of your gross wage. So the idea there is if you can't work for whatever reason, past your waiting period on your income protection policy, you can claim on that. So I think income protection is really important. And you can have, if you've got all 4 levels of cover there, and let's say, for example, you have a TPD, you can't work again, you get the lump sum paid out, cover everything. And if you've got income protection as well, you'll actually get the income stream from your income protection. So there's a bit of overlap in those types of cover. But again, most people don't really understand what insurances are. And another thing I think it's worth saying is that a lot of people out there who have industry super funds, they'll have what they call default insurance cover. And default insurance cover is you didn't apply for that cover when you opened up the super fund. They just, the super fund give you that cover. Now, a couple of important things. Default insurance cover is very minimal. You're not going to have $500,000 worth of TPD cover there. If you check your last superannuation statement, and you'll see that the amounts are quite low. But the other important thing is that they don't tell you is that when you've got that cover, it wasn't medically underwritten. So what that means is if you've got a pre-existing condition, one day you go to claim on that insurance, if they can prove that you had that condition already, then they don't have to pay you. So that's something that people are not aware of. And as a planner, I read a lot of case studies where people have been declined for TPD payouts because they've had a pre-existing condition. So again, my message is check your statement, see what's on it, see what cover you've got, and come and have a chat and we can try and work out how you actually get real comprehensive cover for a good price. Obvious reasons why we need insurance: protect you and your family. I've got a wife, 2 young girls, a dog, mortgage. I'd hate to see all that go. All the things we preach about, putting money into super and building up our wealth and preparing for our retirement, that can all come crashing down in a heartbeat if something happens. You either pass away or have an accident and you don't have the appropriate protection in place. Reducing the stress, obviously, the condition that you've had is going to give you enough stress as it is, so you don't want the financial stress on top of that as well. But to provide financial security or enjoy financial security and peace of mind, that's the best we can do when we provide insurance, and to provide a legacy. So again, your family's not left with nothing. They're not forced to have to sell the house and sell up all your superannuation. Thank you. TJS accounting and TJS financial planning provide fantastic services. There's so many different things we can provide in terms of advice and steering in the right direction, even to the point of referring you to other specialists if we can't help you. You can see there on the screen all the different types of services that we can provide. I think it's important, like Tori said before, don't feel you're alone. Come and see us. Let's talk about your situation. Everyone's got some sort of need for those different services there. We're more than happy to put you in front of the right people to help you. And surround yourself with people who shine. Planners, accountants, bookkeepers. We've got some good mortgage brokers that we often refer clients to, and solicitors now. There's so many people out there who can help you, but they can't help you and we can't help you if we don't know what your problems are. So ask for advice. That's not my family. That's a nice slide. As Tori said before, do something for yourself. Life's busy. I feel that every day, especially with COVID going on. It's really busy. So whatever it is, go and hit a golf ball. If you're allowed to, of course. Grab yourself a coffee, read a book, put a record on. That's what I've been doing while COVID's on. And it's just amazing, just half an hour doing those sorts of things. What I can do to the soul. Speaking of COVID, there's a lot going on with COVID at the moment in terms of the support packages. Job Seeker 2 has come out. Early release of super, so that's in vogue now. You can, if you want to pull some money out of your super. My take on that as a planner is don't just do it for the fun of it. I read something the other day that people were pulling money out of super and sort of spending it on retail therapy. The damage that can do to your super over time is quite large. So only sort of go down that avenue if you really need to. Come and have a chat, and I'm happy to talk to you about that. Grants, the IBA Indigenous Relief Package, all these forms of support have come about as a result of COVID-19. So there's a lot of people out there working for you. You're not alone. Right. Are you okay? So much of this on Facebook, bus stops, football sponsorships and so forth. It's fantastic, and I'm glad one day if I ever need help in this area, I know where to go. Don't feel you're alone. Don't wait for an opportunity to create it. So again, like one of the slides earlier on, if you just sit back, you might be lucky. Things might work out for you, okay, but what are you missing out on if you don't try and create your own opportunities? And again, if you fail with something the first time, don't worry, you've had a crack at it. Go again. Another disclaimer, again, just to remind people that the things we went through today, I hope you enjoyed it. There's a lot of information in there, but certainly don't go out and start doing things yourself. It's good to read things, it's good to Google things, and already you're watching this presentation, so you're halfway there. You clearly have a need, or you think you've got a need to do something. Here's our contact details. Just one final comment. I just want to say that, again, if you need advice, you want to have a chat, it's not going to cost you to have a discussion with me. I'd love to talk to you. Don't hesitate to reach out to us, send us an email, or give us a phone call. And I want to thank Kinaway too on behalf of TJS Accounting and myself, just to thank Kinaway for this fantastic opportunity to present to your members online. It's been a good experience for me, and I certainly hope we can help some of your members. So thank you.
Sure. Thank you both to Tori and Warren for joining us today, for providing some really helpful financial information for our members, particularly in their personal sort of situations. So on behalf of Kinaway and on behalf of the participants, I just want to thank you both for joining us this morning. I understand we do have a few questions that we had come in, so they should pop up on the screen anytime. I'll read them out, and then either if we can get either Tori or Warren to address them, that'd be great. So now the first one is from Graham. And he asks, I've got a student debt from my time at uni. When does it start getting repaid?
Okay. Student debt, so that can be HECS or a HELP debt. Sometimes there can also be student loans. So if you're an apprentice and you've taken a student loan, now they all start being repaid when you actually start earning income and deriving income, and it is actually based upon your taxable income. So when you, are earning the income and you get to a certain level, it is a requirement that the compulsory repayment is paid back within the tax return. Now, if you're filling out a tax file number declaration with your employer, you'll notice that on the pink form that you're filling out, one of the questions does ask, do you have a debt? You should always tick yes to that, and your employer will actually begin deducting a little bit extra tax in your pay as you go. So you'll see that reconcile at the end of the year when you do your tax return.
Cool. Hope that helps, Graham. Next one is from Jess. Thanks for today, Tori and Warren. How should I claim my family tax benefits? Fortnightly, quarterly? I understand you could even do it on an annual basis as well.
Yeah, no, that's right.
Mm.
Really, I think that's a great question, and is covered off when you do your budget. I think it's a case of really understanding what your financial needs are on a monthly basis and how your cash flow is affected. If you're introducing it into your budget, you'll actually be able to determine, if we have a look back at the slide that we're looking at with that example in the month by month, you'll see if you're meeting your expectations and outgoings, or whether or not you could actually do with the money in your hand at that point in time. So great question, but it really is a case-by-case basis and something that you should have a look at when you're doing your budget.
Sure. Thank you. This one is from Mandy Moo Button. She asks, hi, is there any free basic bookkeeping tools for businesses similar to the one that ATO used to provide that you would recommend?
Look, there is a lot of bookkeeping tools out there. Unfortunately, most of the really great performing ones you do pay for. The ATO provides you with a basic tool, but if you're looking at things like MyOb and Xero, it is a pay as you go system, but it will be determined by the type of requirements, business and bookkeeping requirements that you have. And you can do a bit of shopping around to determine which program is the best for you and meets your needs.
Yeah. Lovely. Thank you, Mandy. This one's from Isaac Harrison, and he asks, would love your personal opinion on self-managed super funds.
Hey?
Oh, that's. I think Warren and I will both have tags on that one. I think it's really dependent upon the individual and their needs and what they actually propose to have within that self-managed super fund. What are your thoughts, Warren?
Yeah, look, I agree. So I wouldn't set up a self-managed super fund just because you sort of don't want to pay fees. If you understand how the cost of setting them up and having them audited, I always say you've got to do it for the right reasons. So make sure that the assets in the fund will justify a self-managed super fund, whether it's your factory or direct shares or whatever the case may be. But I would say more people set up SMSFs for the wrong reasons, put it that way.
Mm-hmm.
Sorry to say, Isaac.
And this one is from Chris, and he asks, I have employees. With everything that's happening in the economy, is there any chance a scheduled general super guarantee increase will be delayed?
Yeah, look, it's a good question, Chris, and I think it's a great idea. I must I haven't heard anything. Sorry, I don't know, but I haven't heard anything, which kind of
There's no
suggests that
expectations at this point.
No.
Look, unfortunately,
And
also is that the budget has been delayed until October. So I think the government, anything that is reviewed by the government at this stage, which would normally have been announced in May, has been postponed until October.
Okay. And when is that next increase due to be implemented?
Next year, I think.
Is it next? Yeah, next year. Yeah. Okay. I was thinking that. Okay, Chris. And I believe we have one more. I heard a bit about accessing super early. What's the overall effects on balance if you do access it early, especially accessing $10,000, say, versus $20,000?
Yeah, look, it depends on how old you are, I think, because then you're measuring it over a period of time. But the stats that I've heard have been for younger people, and the effect on their balance over the rest of their working life is huge. And I think the problem is it's not so much that effect; it's actually you're probably not going to discipline yourself to topping that money back up at some point. So again, if you're desperate to get it, do it. But I just make sure that if whatever possible happens down the track, you can actually have an opportunity to start topping that money up. Otherwise, it definitely will have a long-term effect on your end balance on your super fund.
Yeah.
And when some people do access, sorry, after you.
On accessing superannuation early, just be really cautious about the rules around the early access due to COVID-19. It is not an automatic process. Not everybody qualifies for it. And unfortunately, there are penalties for people who are applying for their superannuation early who don't qualify. So if you are not sure if you do qualify or not, do seek assistance and get some advice on that.
Sure. And for people that do access their super early and they do want to top it back up in future's time, are there any sort of benefits or tax sort of concessions around that if they do make more voluntary contributions back into it?
Look, I think if you have accessed your superannuation due to COVID-19 and taken out for that purpose of gaining access to your superannuation, the ATO is watching, is all I can say. Now, if you re-contribute in order to get a tax deduction for it, it could be seen as a scheme, and there are heavy penalties that go with that. So the purpose of actually accessing that superannuation due to COVID-19, the real purpose of that was because people had lost their jobs or really affected financially, and it was there as a financial assistance in meeting their day-to-day needs, not as a scheme. So just be very cautious with that program.
Can I just say also, the limit's at 10,000 times 2, so you don't have to take out the whole 10,000. We had a client who took out, I think, 5,000 or 6,000. So in other words, they generally looked at what they needed. They didn't just take the lot. So don't forget that as well if you're desperate and need some money.
Yeah, and I guess that's important to note as well, because that few thousand that you might leave in there, it obviously accumulates over the lifetime of that superannuation fund. So yeah, it does accumulate to be a bit more than that initial amount. So the
other thing that you should be mindful of, if you do have insurance within your superannuation, and I guess Warren could provide more information on this, but if you did have any of those income protection or life insurance and then you have withdrawn your superannuation, those insurances may not be there long term. So, there are dire consequences to accessing that superannuation and taking those funds out. So all of which should be considered, I guess.
Yeah, sure. Okay, well, Tori and Warren, I think that is it for the questions for this morning. So, again, just want to thank you both. Would just like to thank you again, Tori, as well, for some really helpful tips today, and particularly for the past few weeks, as well, for really important for our businesses, which is something that's perhaps misunderstood. Some financials around business, and it is quite important to the overall health of a business. And it can appear to be daunting, I think, at times as well. So it's really been nice to have you in and kind of just break that down and make it seem, not so hard to approach, I suppose.
Thank you.
You're welcome. And also, just like to thank you as well, Warren, for joining us today and providing some really and useful know-how and providing us with your expertise this morning. So, I'd just like to thank you.
Thanks, James.
You're welcome. And I'd just like to thank everyone else who tuned in this morning. Again, I'm sure you found Tori and Warren's presentation useful today, and also for the past few weeks as well with Tori. So for all you Kinaway community, don't forget to tune in this Friday at 11 a.m. for Empower Digital's on-call webinar. Also, if you think the Kinaway Business Support Package may be of value to your business, please jump on the Kinaway website to fill in your EOI to get access to these business support packages. Thanks again to Tori and Warren for joining us. Thanks to everyone who tuned in, and we'll see you on Friday. And in the meantime, please subscribe to the Kinaway Facebook and YouTube channels, leave a like on today's video, and turn on the notifications, and we will see you all on Friday.